January 1st, 2026. China activated a licensing system that just locked Western buyers out of 60 to 70% of the world as refined silver supply. Not gradually, not with negotiations, overnight. In New York, physical silver is trading at an 11% premium over paper contracts. That's an $8 gap between what you can hold in your hand and what exists only on computer screens. Here's what they're not telling you. For every single ounce of actual silver sitting in warehouses, there are 356 paper contracts claiming ownership of that same ounce, 356 to 1. And 93% of Chinese refiners just stopped honoring Western orders. What happens when those 356 claims come due for physical delivery? Welcome to Financial Revelations. If you've been navigating markets long enough to remember when a handshake meant something, when contracts were printed on paper, not pixels, then you understand why what I'm about to show you matters. Do me a favor. If you value straightforward economic analysis, without the noise, without the hype, click that subscribe button, not because I'm asking, but because the information coming in the next few minutes could reshape how you think about markets, currencies, and the very foundation of global trade. And before we proceed, drop a comment below. Tell me where you're watching from. Are you in North America, Europe, Asia? Because what's unfolding right now doesn't respect borders. And I want to know whose supply chains are about to feel this first. Now, let's talk about what really happened during those 8 hours. On the first day of 2026, while most of the world celebrated new beginnings, China's Ministry of Commerce activated a regulatory framework that would fundamentally alter global silver markets. The announcement appeared routine, bureaucratic even. New export licensing requirements for refined silver, effective immediately. But within 8 hours, Western procurement officers discovered something alarming. They couldn't buy Chinese silver anymore, not at any price. The official policy stated clear requirements. Any refiner seeking export licenses must demonstrate annual production capacity exceeding 80 tons and maintain documented export activity spanning 2022 through 2024. On paper, this seemed reasonable, standard compliance protocols, quality assurance measures, but the numbers told a different story entirely. China operates the world's largest silver refining infrastructure. Thousands of facilities scattered across provinces, processing raw ore into pure metal that flows into electronics, solar panels, medical devices, automotive components. These refiners fall into distinct categories by size. Large, state-affiliated operations, producing hundreds of tons annually, dominating the official export statistics. Then come the mid-sized private refiners, 50 to 80 tons per year, often family-owned enterprises spanning multiple generations, and finally, thousands of small workshops, 10 to 40 tons annually, the backbone of China's industrial metals ecosystem. When analysts calculated the numbers, a pattern emerged. Approximately 93% of registered silver refiners operate below the 80-ton threshold. 93%? These weren't marginal players. Together, they represented nearly half of China's total refining capacity, the flexible, responsive portion of the supply chain that Western buyers had relied upon for decades. The licensing requirement effectively excluded them from export markets, not through direct prohibition, but through mathematical impossibility. They simply couldn't meet the production threshold. But something else happened during those first 8 hours, something the official policy documents never mentioned. Western buyers contacted the 7% of large refiners who did qualify for export licenses. These were established relationships, contracts spanning years, volume commitments worth hundreds of millions of dollars. The refiners refused to sell, not because of licensing barriers. They had the permits, not because of production constraints. Their facilities operated at normal capacity. They simply declined Western orders, offering no explanation beyond vague references to internal allocation priorities. Industry investigators began making calls, following money trails, analyzing shipping manifests. What they discovered revealed a coordinated pattern. Large Chinese refiners were redirecting output toward domestic industrial consumers, state-owned enterprises building solar farms, electric vehicle manufacturers expanding production lines, technology companies securing strategic material reserves. Meanwhile, smaller refiners who historically served Western markets found themselves unable to export and unable to find domestic buyers willing to purchase their full output at previous price levels. The system created perfect segregation. Large refiners with export permits served Chinese industrial demand. Small refiners without permits faced reduced domestic demand. Their traditional Western customers now unreachable. Western procurement teams scrambled for alternatives. They contacted refiners in Mexico, Peru, Australia, Canada, every non-Chinese source capable of producing refined silver. The response was uniform. Existing production was already committed. Long-term contracts locked in place. No available capacity for new buyers. Not at current prices. Not at any price that made economic sense. Because here's what Western buyers didn't initially grasp. China doesn't just refine silver. It refines most of the world's silver. Between 60 and 70% of global refined silver passes through Chinese facilities, transformed from raw ore and recycled scrap into pure metal meeting international standards. For 2 decades, this system functioned smoothly. Chinese refiners exported to Western markets. Prices remained stable. Supply chains hummed along without disruption. Western industries built entire manufacturing strategies around reliable Chinese silver supply. Procurement departments optimized for just-in-time delivery. Financial hedging assumed continuous market access. Nobody questioned whether that access might simply disappear. The 8-hour investigation period revealed something more troubling than supply disruption. It exposed intentional market restructuring. China hadn't accidentally created a licensing system that excluded 93% of refiners. They engineered it precisely, and the large refiners who could export chose not to. This wasn't a regulatory adjustment. It was economic architecture. Deliberately constructed, strategically activated, and it had just locked Western industries out of the world's primary silver supply. The question wasn't whether this would cause problems. The question was, how soon would those problems become impossible to ignore? Not a price, not a volume figure, but a ratio, 356 to 1. For every single physical ounce of silver sitting in COMEX warehouses in New York, there exist 356 paper contracts claiming ownership of that exact same ounce. Let that sink in for a moment. Imagine walking into a bank, presenting your account statement showing a balance of $10,000, and discovering that 355 other people hold identical statements, all claiming that same $10,000. The bank smiles politely, assures everyone the system works fine, as long as not everyone wants their cash simultaneously. This is precisely how the modern silver market operates. And China just announced they're no longer depositing money into that bank. The COMEX, the commodity exchange in New York, functions as the primary venue for silver trading in Western markets. Futures contracts changing hands electronically. Billions of dollars in daily transactions, prices flashing across terminal screens worldwide. But these aren't transactions for physical metal. They're promises, contracts guaranteeing future delivery, financial instruments that settle in cash 99% of the time. Actual silver rarely moves. The paper moves instead, traded, leveraged, rehypothecated, the same ounce claimed by hundreds of different contract holders. In gold markets, the system maintains some restraint. Approximately 30 paper claims exist for every physical ounce. High leverage, certainly, but manageable during normal market conditions. Silver operates at 12 times that ratio. Why such extreme leverage? Because for decades, physical silver flowed freely. Chinese refiners exported consistently. Mexican mines shipped reliably. Recycling operations processed industrial scrap. The physical supply seemed inexhaustible. Market makers could sell paper contracts confidently, knowing that if delivery demand spiked, they could source physical metal within days from China, from anywhere. That assumption just shattered. On January 1st, futures contracts for silver delivery traded at $62 per ounce in New York. Physical silver. Actual metal you could touch, hold, store in a vault, traded at $70 per ounce, an $8 premium, 11%. In healthy commodity markets, this gap doesn't exist. Paper prices and physical prices converge. Arbitrage traders eliminate discrepancies within hours. But arbitrage requires something critical, the ability to convert paper into physical, buy the cheaper futures contract, take delivery of actual metal, sell the physical at the higher price, pocket the difference. Simple. Except now, you can't get the physical metal. Chinese refiners aren't shipping. Alternative sources are committed. The conversion mechanism is broken. So the gap persists and widens. Financial analysts began running scenarios. What happens if contract holders decide they want physical delivery instead of cash settlement? COMEX rules allow this. Any futures contract can demand physical metal. The exchange must provide it. That's the foundational promise underlying the entire system. Current COMEX inventories hold approximately 280 million ounces of silver. Sounds substantial, until you calculate outstanding contract obligations. Nearly 100 billion ounces worth of paper claims, against 280 million ounces of physical metal. The math doesn't work. It never had to work before, because only a tiny fraction ever demanded physical delivery. But that was when Chinese refiners exported freely, when replacement supplies arrived continuously, when the paper system had a physical foundation beneath it. Remove that foundation, and the leverage becomes visible. Institutional investors started asking uncomfortable questions. The silver ETFs they owned, supposedly backed by physical metal. Were those holdings actually allocated? Individually identified? Stored separately? Or were they part of the same fractional reserve pool, the same 356 to 1 leverage, the same phantom inventory claimed by hundreds of different parties? Phone calls flooded vault operators, custodian banks, exchange officials. The responses came carefully worded, legally precise, technically accurate, and profoundly unsettling. Yes, the silver exists, in aggregate. Yes, the audits confirm inventory levels on specific dates, under specific conditions. But no, your specific bars aren't separately identified. They're part of pooled storage, fungible inventory, allocated proportionally. Which means 356 people all own the same bar, simultaneously. And the entity that was supposed to keep the pool topped up, the entity that refined and exported the physical metal that made this fractional system possible, just stopped participating. The paper market continued trading, prices flickering on screens, contracts changing hands, the machinery still functioning, but beneath the surface, something fundamental had broken, and nobody knew how to fix it, without admitting the system was never sustainable in the first place. There's a factory in Stuttgart, Germany, that produces 3,200 electric vehicles every single day. Each vehicle requires approximately 25 grams of silver buried in circuit boards, coating electrical contacts, ensuring millions of microscopic connections function flawlessly for a decade. Do the math, 80 kilograms of silver per day for one factory. On January the 2nd, the procurement director received a notification. Their primary silver supplier, a trading house sourcing from Chinese refiners, could not fulfill the next quarterly contract. No alternative pricing offered, no negotiation possible, simply unavailable. The factory maintains a 90-day strategic reserve, 90 days to find a new supplier, restructure the supply chain, or halt production. This story is repeating across continents, in thousands of facilities, manufacturing technologies that define modern civilization. Solar panel production consumes more silver than any other industrial application, approximately 130 million ounces annually, a figure projected to reach 185 million ounces by 2027. Silver paste creates the conductive pathways that transform sunlight into electricity. No viable substitute exists, not at current efficiency standards, not at commercial scale. Every solar panel represents a permanent claim on silver supply. The metal doesn't recycle back into markets. It's embedded in rooftop installations, locked into solar farms spanning square miles. Committed for 25-year operational lifespans. China manufactures 80% of global solar panel capacity. Chinese companies consume their domestically refined silver, feeding it into production lines that export solar panels worldwide. Western solar manufacturers, the remaining 20%, source silver from international markets, markets that just lost access to 60% of refined supply. The bidding war has already begun. Medical device manufacturers face similar calculations. Silver's antimicrobial properties make it irreplaceable in wound dressings, surgical instruments, catheter coatings. Semiconductor fabrication requires silver for specialized applications. 5G infrastructure depends on silver-based conductive inks. Electric vehicle charging stations use silver contacts rated for thousands of connection cycles. These aren't discretionary applications. These are foundational technologies, infrastructure investments, medical necessities. Industries can't simply reduce consumption, switch to alternatives, or postpone production schedules. The demand is structural, non-negotiable, and accelerating. Before January 1st, global refined silver supply approximated 1 billion ounces annually. Mine production plus recycled material distributed across industrial users. Investment demand, jewelry manufacture. Industrial consumption alone exceeded 600 million ounces, more than half of total supply, a percentage climbing steadily as technology adoption expands. Now subtract 60 to 70% of Chinese refining capacity from markets serving Western industries. The available supply drops to roughly 400 million ounces, against demand exceeding 600 million ounces, a 200 million ounce annual deficit. Economists call this demand destruction, the point where rising prices force consumers out of markets, where manufacturers halt production, where entire industries restructure around scarcity. But silver demand doesn't respond to price signals the way crude oil or copper does. An automaker can't produce an electric vehicle with 15 grams of silver instead of 25. The electrical systems fail. Safety certifications evaporate. A solar panel manufacturer can't reduce silver content by 30%. Efficiency drops below commercial viability. The panels can't compete. These industries face binary choices: secure silver supply at any cost, or stop production entirely. Commodity traders understand what happens next. Industries with the highest margins, the most critical applications, the deepest financial reserves, they'll bid prices upward, securing whatever physical supply exists, regardless of cost. Marginal users get priced out. Smaller manufacturers, specialized applications, anyone without the capital to compete in a genuine scarcity market. But here's the mechanism that transforms shortage into crisis. Most manufacturers don't buy silver directly from refiners. They purchase through intermediaries, trading houses, commodity brokers, financial institutions that aggregate supply. These intermediaries operate on leverage. They sell forward contracts to manufacturers, guaranteeing delivery 6 months ahead, then source the physical metal closer to delivery dates. It's efficient, it's cost-effective, it works beautifully when supply flows freely, it collapses catastrophically when supply disappears, because those forward contracts are already sold. Legally binding commitments, delivery obligations to factories that have already structured production schedules around guaranteed silver supply. And the intermediaries can't source the metal anymore. Force majeure clauses start appearing, legal notifications declaring that unforeseen circumstances prevent contract fulfillment, apologies offered, penalties negotiated, but penalties don't restart production lines. Financial compensation doesn't replace strategic materials. The Stuttgart factory has 88 days of silver reserves remaining. Then what? Do 3,200 vehicles per day simply stop? Do solar panel installations pause while manufacturers scramble for materials? Does medical device production halt, leaving hospitals without critical supplies? Nobody knows. Because this scenario has never happened before. Not at this scale, not across this many critical industries simultaneously. And it's only been 3 days since China activated the licensing requirements. 3 days. What happens at 90 days? Silver isn't the first critical material China has weaponized. It won't be the last. In 2010, China restricted rare earth element exports following a territorial dispute with Japan. Prices spiked 750% within months. Western manufacturers scrambled. Defense contractors faced production delays for guided missile systems. The world promised it would never be caught unprepared again. Yet here we stand, 16 years later, watching the exact same playbook execute with surgical precision. Only this time, the stakes are exponentially higher. Rare earths power niche applications, specialized magnets, catalytic converters, military hardware. Silver powers everything. In July 2023, China imposed export controls on gallium and germanium, materials critical for semiconductor manufacturing, military radar systems, fiber optic networks. Western governments issued strongly worded statements, promised strategic reserve stockpiling, announced initiatives to develop alternative supply chains. Nothing materialized at scale. In December 2024, China tightened antimony export restrictions, a metal essential for flame retardants, ammunition manufacturing, infrared sensors. Again, diplomatic protests. Again, no substantive supply chain restructuring. The pattern is unmistakable. China systematically identifies materials where they control dominant market share, establishes export licensing frameworks, then restricts access based on geopolitical alignment. Silver represents the most consequential application of this strategy yet, because unlike rare earths or antimony, silver shortages don't just impact defense contractors or specialized industries, they cascade across the entire technological foundation of Western economies. Intelligence analysts are now mapping which nations maintain silver supply access and which don't. The results reveal a strategic architecture. Russia continues receiving Chinese silver exports, contracts signed, deliveries flowing, refiners honoring commitments, Belt and Road. Initiative partners in Southeast Asia, Africa, Latin America, their procurement channels remain open. Nations participating in China's digital yuan pilots, members of the Shanghai Cooperation Organization, countries that abstained from UN resolutions criticizing Chinese policies. They're getting silver. The European Union, the United States, Japan, South Korea, Australia, Canada. They're not. This isn't economic policy. This is alliance system construction, built on resource access rather than military treaties. China is offering a straightforward proposition to developing nations. Align with our strategic framework, and your industries receive the materials they need to grow. Maintain Western partnerships, and watch your manufacturers bid against each other for scraps. Western policymakers are finally asking the question they should have asked decades ago. How did we allow such concentrated dependency to develop? The answer is uncomfortable. Globalization optimized for efficiency, not resilience. Corporations chased the lowest production costs, ignored geopolitical risk, built supply chains, assuming perpetual cooperation. Nobody wanted to pay the premium for diversified sourcing when Chinese refiners offered superior pricing and reliable delivery. Now the bill comes due. Restarting domestic silver refining capacity requires years, not months. Environmental permits, facility construction, workforce training, establishing quality certification, building customer relationships. And even if Western governments fast-track every approval, provide unlimited subsidies, waive regulatory requirements, where does the raw material come from? Silver ore doesn't magically appear. Existing mines operate at capacity. New mine development takes 5 to 7 years from discovery to production. Recycling infrastructure can expand, but recycled silver primarily comes from industrial scrap and end-of-life electronics, the very electronics that manufacturers can't produce because they don't have silver. It's a closed loop with no entry point. Some analysts suggest Western governments should release strategic reserves, stabilize markets, buy time for supply chain restructuring. There's one problem. Most Western nations don't maintain strategic silver reserves. They stockpile crude oil, wheat, medical supplies, materials deemed strategically critical. Silver was never classified as strategic. It was just another commodity, freely traded, abundantly available, until it wasn't. The geopolitical implications extend beyond manufacturing disruptions. Financial markets are beginning to price in a fundamental restructuring of global trade relationships. Nations with reliable silver access will dominate next-generation technology production, electric vehicle manufacturing, renewable energy infrastructure, advanced electronics. Nations without access face a choice: realign geopolitically to secure material supply or accept technological stagnation. This is leverage that transcends traditional military or economic power. Control the materials that enable modern civilization, and you control which nations advance and which fall behind. China has been systematically building this position for 2 decades, mining acquisitions across Africa and South America, refining capacity expansion, strategic material stockpiling, export control frameworks, not random corporate decisions, coordinated national strategy. And the West is discovering the consequences. 90 days of inventory at a time. The question isn't whether Western nations will adapt. The question is whether they can adapt fast enough, at sufficient scale, before critical industries simply relocate to regions where silver flows freely, taking jobs, technology, innovation, and economic power with them. China isn't restricting silver exports to punish Western nations. They're restructuring the global economic order, one critical material at a time. And silver, invisible, essential, irreplaceable, might be the lever that accomplishes what military might never could: the peaceful transfer of technological supremacy, 1 ounce at a time.